Welcome to the B.F. Anderson Technical Report for September 22nd. One of those most important factors that needs to be discussed is the concept of volume. And I want to introduce to you this morning to the concept of dollar volume. You know, in order to be successful at investing, you have to have an edge. You've got to have some type of advantage over the crowd. And Peter Lynch wrote a book on this. He wrote a book called One Up on Wall Street, where he discusses this edge that the small investor has. And in his opinion, most small investors don't realize that they have this edge. So if you think about it, what he's trying to say is that when you deal with a large financial organization that's managing billions, if not trillions of dollars, they don't have the same edge that you have as a small investor. So when you go with, let's say, a large mutual fund or an index fund or whatever, you're basically giving up on that edge and simply saying, I don't understand that I have an edge, or I don't care that I have an edge. But when you commingle your funds with billions of other dollars, you tend to lose the edge. So what is the edge? The edge is that you've got to have the skills in order to find investments that are good. These are good investments. But even more importantly, you've got to find these investments before the next guy. So then you have to define who's the next guy. Well, once you understand that over 80% of the volume on the exchanges is driven by large institutional investors. I'm talking pension plans, mutual funds, hedge funds, foundations, etc. So once you realize that you need to find something good and then get there before the next guy, and you say, well, I want to get there before Aunt Sue. Well, Aunt Sue is going to only be 20% of the equation, whereas the institutional investor is going to be 80% of the equation. And my advice would be, and my opinion would be, you should fish in that pond where the institutional investor can come in behind you and drive your stock price higher. So here is a graph of a company called Daktronics. Now, the reason I bring this up, I was asked recently by a friend to evaluate this stock. And so just to kind of go through the thinking on it, the client, or my friend, is interested in it for really one reason and one reason only. It's a $10 stock. Also, it pays a dividend. Now, these guys are involved in making signs, electronic signs for like football stadiums and so forth. And I think they make the one for the LSU stadium, so that's kind of why he knows about it. So once you realize that this company, like yesterday, traded 143,000 shares. Now the average day is 190,000 shares. So in order to calculate dollar volume, which is what I'm trying to get across to you is, and it's very simple. This is a very simple concept. 190,000 shares times the price of $10, which is the price of the stock, means that dollar volume is $190,000 per day. Now, if you start thinking about this and you go, okay, I'm a large money manager. I manage a $10 billion fund, and I want to put a certain percentage of $10 billion into a stock that trades $190,000 a day, and the bottom line is you really can't do it. And if you do it, you're going to do an infinitesimal amount of your portfolio, a very small amount. We're talking micro amount in the portfolio, because as a money manager, you're going to have to say, okay, well, if this thing goes bad on me or if things don't work out, there's not enough liquidity in this stock where I have flexibility where I can get out of it. So you can see the problem here with this particular company for me would be, I've got to depend on other small investors to drive this stock price higher, which may or may not happen. It could happen. There's no question about it. But I really feel your odds improve when you're fishing in that pond where you've got 80% of the volume, which is the institutional investor. So I wanted to go ahead and just talk about the top 5 in this fashion, because we can use this as a way to just continue to understand the concept. Now, what I personally believe, and I think the critical level is, I think once a company starts trading dollar volume of about $50 million a day or more, you're going to really start to attract the institutional investor, because a $50 million a day trader, and like I said, this one back here is only $190,000 a day. I'm saying 50 million a day. So if you take Align Technology, which is one that continues to make our list, which is in the medical field, it trades on average 930,000 shares a day. The price is roughly 190, so that's $177 million a day. So if you're a large institution, you could possibly be interested in this. Here's Alibaba. Now look at this horse. 18,500,000 shares a day times a price of 178 is $3.3 billion a day. So again, if you're running a 10, 20, 30, $100 billion mutual fund or whatever, this stock has enough liquidity in it that you can probably get involved in it. By the way, Alibaba, we've talked before, is the Amazon of China, continues to look good. Here's a new stock that's coming onto our list, and it's kind of an old name that we got involved in back in the earlier part of the decade. First Solar, which is industrial-sized solar farms. Well, they make the technology for that. They do have a unique technology. Anyway, 2.2 million a day times a price of 49 means that it trades $108 million a day. So you've got at least over that 50 million level, and you can see where that would be beneficial. Now here's another example. This is one of the stocks that came on about 2 weeks ago, a company called Novocure. They've got an interesting technology regarding the treatment of cancerous tumors using electronic fields. It's called TFF. It's a very interesting technology. Now, here's the problem. We got 900,000 shares a day times a price of 21, so your dollar volume is less than $20 million a day. So it would be something, if I saw this, I would say, okay, this is an interesting situation. I think I'm going to let it ripen a little bit, which means let the volume pick up. Over time, if the company is successful, the dollar volume will get over 50 million. Now, the stock may double in the meantime, but I would definitely be aware of the fact that this stock lacks the liquidity requirements needed for a true situation with institutions. Now, here's NVIDIA. Again, continues to look good. Now, it did have a pullback this week due to the fact that Tesla has made an announcement that they may no longer be using the NVIDIA processor in their cars, and they're working with AMD on developing their own processors. So I think I would watch this one for a while. But again, you can see the dollar volume, 3.5 billion a day. So very liquid, easy to get in and out of. Now, last but not least, let's talk about what's going on in the economy. Is the economy strengthening? Well, if you listen to the market, one of the most economically sensitive areas of the market is the semiconductor stocks. Now, this is a ETF of semiconductor stocks. As you can see, last week or this week, we've hit an all-time new high. We've had a pullback the last couple of days, but this sector looks very promising, which tells me that the economy is doing well. And then vice versa, if you look at this group, which is an ETF of consumer staple stocks. These are what I call toothpaste stocks. In other words, if you are in a dire economic situation and the economy's in recession and unemployment is high and you need to get a job, well, you're at least going to go buy some toothpaste to brush your teeth so that when you go to your job interview, you can have clean teeth. But the point is, these are very, very defensive stocks, and you can see these things are breaking down. So there's somewhat of a rotation out of the defensive area more into the economically sensitive area. This is a very good sign. So if you have any questions, give me a call. Thank you very much.